Are you a veteran looking to buy a home and having a hard time qualifying? There's this little VA trick that is allowed, and that is to ask the seller to pay off your debts when you're buying a home. It is a crazy rule and one that can be very, very useful. It's something we're going to talk all about in today's video. My name is Peter Lindquist. I'm with the Lindquist team, and hey, I'm here with Travis Anderson, a great realtor in the Twin Cities area. If you like this video, I certainly would appreciate it if you gave it a thumbs up. And if you've got any questions, feel free to leave them in the comments below. And certainly feel free to subscribe to the channel. With that, let's just go get started.
Hey, Peter, we were talking the other day about VA financing, and there's this special trick that VA financing has. To my understanding, it's not available in any other loan program. What is it that we were talking about?
VA has a really interesting qualifying trick where the seller can actually pay off a veteran's debts for any reason. I normally use it in the event that a buyer is going to qualify. So, typically the seller can pay up to 4% of the purchase price towards a buyer's closing costs. And most often, that's what we do. We use it to pay closing costs. But we can use all or some of that to actually pay off a veteran's debts, which is pretty crazy.
That is very crazy. So, with other mortgage products, we can't do this. Is that
There's no other mortgage product like that. Before people get too excited, I want to clarify that there are specific reasons when it's a good idea to do this, and there are general reasons when it's not a real good idea to do it.
yeah? Can you first give us an example of what that might look like? Maybe a little bit of the math.
Let's say I've got a veteran who comes to me and they want to buy a $500,000 home, but they qualify to a $400,000 home. They've got this house and they know they want it, so how are we going to get them there? So I look at what their debts are, and let's assume for the moment they have a car loan that has $20,000 remaining on it, and the monthly payment is $650. So, one solution to this problem, in this case, the veteran has enough money for their closing costs, but they don't qualify to be able to buy that $500,000 home. So now what we do is we ask the seller to pay 4% of the purchase price towards the veteran's closing costs. And now with that money, 4% of 500,000 is magically $20,000. So with that $20,000 on the day of closing, we're going to use that money to pay off the veteran's car loan. So now they don't have that $650 a month. So now the veteran qualifies to the $500,000 home. So in that instance, if there's no other way to qualify, that's a perfect use of seller paid closing costs to pay off a veteran's debt that allows them to qualify for the house of their dreams.
Something like this, I assume, wouldn't happen very often, or does it?
I've only used it a couple of times. I've had veterans ask about it. Now, let me just tell you the negatives to it. So that what I just described is kind of the narrow instance when I think it's a good idea. The places where it's a bad idea is, I've got $20,000 worth of credit card debt and I qualify to buy the home, but I just want to put it into the mortgage. And so the immediate thought is, well, hey, I'm taking this credit card debt and I'm getting rid of those payments and putting it into my mortgage. That's good, right? Well, the finer point to that is you're taking all of that $20,000 and now you're spreading it over 30 years. Separately from that, what I'd recommend is a debt consolidation loan or some other way of paying off that credit card debt. Even if it's at a higher interest rate, paying it off over 4 or 5 years is going to make more sense than adding it to the house debt and paying it over 30 years.
Yeah, this is a total tangent, Peter, but I feel like with rates a little bit higher right now, I'm starting to see marketing from mortgage companies asking people to consolidate their debt into their mortgages. So I'm starting to see that as like a tactic today that a lot of lenders are doing. I like your approach here where you're like, well, wait a minute here. Do you really want to finance your debts over the course of 15 or 30 years, depending on the length of your mortgage? The answer most of the time is you probably don't want to do that. But in some instances, like you're talking about with this veteran loan, in some instances, look, if we can pay off a car loan or a student loan or something like that, and then it allows you to qualify for the home that you wouldn't have otherwise qualified for, here's a way in which we can do that, right?
I'll just note on you. You've got it. You nailed it exactly. What I want to note is you brought up a refinance, and it applies in this instance. It's the same principle, and you're exactly right that you're consolidating debt into a 30-year loan. You're also taking up equity, making it harder to sell your home in the event that you need to, reducing whatever the down payment is, on your next home. You're also making that credit card debt turn it into, well, they can foreclose on you, if you don't make your mortgage payments. So, there's, I, I just think there are times when that makes sense. There are definitely times when I suggest it to a veteran that this is the only solution and a good one. But I'll tell you, most of the time, it's a much more limited instance, I think, when using the mortgage to pay off other debts makes really great sense. And in this case, when buying a home to get that house of your dreams, that would be a good way to use it.
And something else that we've talked about in other videos, and it's something we probably can't talk about enough, but in your exact example, it's 500,000. You're asking the seller to pay 20 towards your closing costs. So now you're at $480,000 is really the offer that the seller is receiving, even though you're paying 500,000. So again, in many scenarios, it would just be better to buy the home for 480 than to buy it for 500. So you're actually inflating the price to cover your costs and things like that. So all of that, are just things that people have to take a really close look at and make sure that the math makes sense for them. And in some rare instances, it might. And it's only available with VA financing, which is super awesome. So, is there anything else, Peter, that we should chat about?
Yeah, Travis, I think there's one other thing, and that is you can't just do this on every house. We've talked about this on another video, but if you're going to ask the seller to pay money towards your closing costs, that really aces you out of many types of offers, especially with multiple offer situation to try to get this done. So I wouldn't say that, as a veteran that, hey, just automatically you can go do this. It has to be the right timing for you and the right house or right seller in particular for that to be negotiated into your contract.
Yeah, that sounds awesome. Great time to wrap it up, Peter. As always, thank you very much. And to the viewers, of course, shoot us a call, shoot us a text, Peter or myself. If you've got any questions, we're always happy to help.